There's a huge debate raging right now between the bulls and the bears about what comes next. Generally, the bulls are fundamentalists who look at individual companies, revenues, earnings, that sort of thing, and what they're seeing encourages them. For example, on Tuesday afternoon, Intel reported a blockbuster quarter. CEO Paul Otellini called it the best quarter in the company's 42-year history. Revenues were up 34% from the year-ago period and were the highest of any quarter in the company's history, slightly topping the previous record from the fourth quarter of 2007. Net income of $2.9 billion was up 175% from the year-ago period and just below the all-time record from the fourth quarter of 2009. Looking at Intel stock, it appears to be a bargain. Shares closed yesterday at $21.36. They have about $3 in net cash and short-term investments on their balance sheet, so you get the business for $18. Over the last 4 quarters, Intel earned $1.82 for a trailing multiple of about 10. This for the leading semiconductor company with a dominant franchise. That's great value. Monday afternoon, railroad operator CXS was similarly impressive. Revenues were up 22% on a 13% increase in volume and an 8% increase in revenue per unit, resulting in a 47% increase in net income from the year-ago period. No wonder the fundamentalists don't understand the current correction and see it as a tremendous buying opportunity. One of the great advocates of this position is Jim Cramer, who on Tuesday on his Mad Money program had a diatribe towards the eggheads. These are economists who are looking at big picture data, jobless claims, unemployment, the debt, and saying, oh, the economy's in for trouble. Cramer saying, look at what the companies are telling you. Get empirical, go look on the ground, and dig into the earnings numbers, and what you'll see is they're showing recovery. CSX, Intel, Alcoa. He also talked about Novellus. It's a great piece. I linked to it in the client note. I recommend you checking it out. On the other side are people who are alarmed by the market action, which has been decidedly negative since the April high. Implicitly or explicitly, these guys are technicians. And they note that the S&P 500 is now down 122% or 10% from its April high as of yesterday's close. It's broken below both its 50 and 200-day moving averages, and volume seems to pick up on down days and be light on up days. More recently, the S&P's 50-day moving average broke below its 200-day moving average in what's known as a death cross. The last death cross occurred in December 2007, and we all know what happened after that. In fact, Eddie Ardini said that every bear market since 1972 has been marked by a death cross. That said, death cross is not a surefire indicator of a coming bear market. It was right in December 2007, and it was an accurate indicator in October 2000 as well, but it prematurely signaled the end of the previous 2 bull markets in July 2006, August 2005, September 1998, and April 1994. So it seems like the death cross is a necessary but not a sufficient indicator for a bear market. So who should we believe? Well, one of the reasons I haven't put out a client note in almost a month is that I was across the country in Alexandria, Virginia, giving a talk and sitting on a panel on the subject of Ayn Rand and investing. In my talk, I reviewed the 2 main schools of investing, fundamentals and technicals, and how each side tends to completely dismiss the other side. The fundamentalists see technical analysis as voodoo and superstition, and the technical analysts think that fundamentalists waste their time on detailed company research that has nothing to do with the performance of actual stocks. As usual in most intellectual debates, each side has some part of the truth while mistakenly believing that they have the whole. Turning to the current situation, the fundamentalists appear to be right that companies are showing solid revenue and earnings growth and are attractively valued. We'll find out more about the fundamentals as companies report second quarter earnings in the next few weeks. On the other hand, the technicians are clearly right that the market action for the last 2.5 months has been decidedly bearish. My own investment philosophy synthesizes the 2 schools while adding in Austrian economics. The core of Austrian economics is an account of the boom and bust cycle. By understanding where we are in the boom and bust cycle that dominates economic and stock market performance over long periods of time, we can make better use of the information provided to us by fundamental and technical analysis. When we look at the macroeconomy, we can see that many large imbalances still exist. Fundamentals based on the previous 12 months are compelling, But the market is acting the way it is because the stimulus and monetary policies that have driven the market and company profits over the last 12 months appear to be waning. The headwinds from the structural imbalances are beginning to reassert themselves and look like they're going to condition corporate results going forward. I spoke more about this tension in a client note from June called Cyclical Tailwinds versus Secular Headwinds. Now, long secular bull and bear markets have characterized the U.S. stock market since at least the beginning of the 20th century. And I've argued many times that we're in a secular bear market since the beginning of 2000. The secular bear market won't end until many of the imbalances, such as the massive budget, current account deficits, and the distortions caused by the Fed's recent policies, work themselves out. This will happen in one of two ways. Policy will become more responsible and will make steady adjustments that will be painful but necessary, or a crisis will flush the system in dramatic fashion, putting the economy on a solid base. Most likely it will be the second one. Until then, the upside is limited.